Okay, so I'm finally getting around to getting the last portion of this interview uploaded. Just finally finished chopping it up. There were some parts that, of course, that I had to take out uh, to call uh, maintain the anonymity of the person that I was interviewing, talking with. Um, there was a decent amount of insight in this. He gave me a couple of the stock picks. I've researched them. I don't feel too good about some of them. Some of them I like the exposure that it gives me. But when you're dealing, especially in some of the energy, mining, and precious metal space, there isn't much growth there at all. Just because you have to look at the market as preppers and hoarders, or should I say, preppers and gold bugs, precious metal bugs, silver bugs. Um, you know, kind of last of the dying breed. It is a big hedge, yes, but definitely can be used in times of you know economic volatility or economic instability is a better way of saying that. But you see that it gives you that little bit of exposure where you can buy different shares. So one thing that he was talking about is like GLD and things like that. I've looked into those, um, me personally, and I'll put my uh, one of my portfolios or a a portfolio that I'm putting together on M1 Finance. I'll put that in the description below. But you will see that over a 5 year period, it probably returns maybe about 22% or so. So not really much, but it might be a decent hedge. I probably will only throw probably about $70 a month into that, if that, probably even less actually, I think. So I throw a little money into that every month, see where it goes, and then go from take it from there or take it day by day as I look at the portfolio and see other things. I do like that exposure, getting into the paper stuff of gold and silver, along with my physical holdings of silver. I just bought another 5 ounce bar, and we'll be buying some more. Keep on keeping to the schedule that I have right now, which is buying 5 ounces per month, just in bars. So that was something I've said before, and the interview itself was pretty good. There's a couple moments where he was just like, "Hey, Mike, man, like you've been doing your research, and definitely a good start." So I felt really good about that. And then kind of went from there, and I learned a little bit just by listening to this whole thing over again. This is a longer interview here. I did include some screenshots of some of the things that we were talking about. He had, a little investment template, if you will, written out for me, and I went ahead and put that in a spreadsheet and showed all the percentages and everything. One thing I did like that he said that he had in there was talking about having a bit of cash reserves, and that's kind of how I'm going to approach this. So I'm not really timing the market, if you will, but I am trying to keep my cash on the sidelines just in case anything happens, that I can jump into the market with that cash. So what I'm going to do is get enough in there into M1 Finance. This is what I finally decided to do. I got about 1,400 set aside for this, but I don't feel too good about getting into this market right now because everything is just so overblown, overbought, overpriced, I should say. And I'm looking at it, I'm like, well, if everything that your Peter Schiffs, your other economists, your doom and gloom, your bull boom bear bust YouTube channel, your silver report YouTube channel, SGT, and other YouTube channels are saying, then this is not the time to really put a lot of money into the market. Now you can't really time the market. It's all about time in the market. Like that's what people keep on repeating, especially in the fire and dividend growth investing portfolio or YouTubers that they talk about. And it's like, okay, that's fine and all, but now I'm looking at, okay, how can I get, in a sense, the best bang for my buck? I want to get into this market. I want to get in while the bloodbath is occurring and buy some of these shares on their way down. Actually, well, not on their way down, but as they're going down and going into settle, meaning that, they're starting to trade sideways, things like that. So if I can, again, I'm learning more and more about this. So some of my terminology may be off. Please research anything that I say. Take it as an inspiration, if anything, for you to like look into some of these things and maybe a starting point for you. So take it however you want. But this is essentially what I'm doing about it. And that's the way I want to approach it. M1 Finance, it's $500 to start a Roth IRA. And then for all the other accounts, I believe it's a minimum of $100. So that's essentially what I'm going to do. I got one Roth IRA and two other accounts or two other portfolios. One is a passive income portfolio that is passive. No, that one's all passive. So it has mostly dividend-based stocks. It's based off of Joseph Carlson's show. It's based off of his portfolio, but I took out a couple of things like his, he had like 1% going to energy, and that was for like ExxonMobil and stuff like that. I kind of got that covered in my MME portfolio, which is my metals, mining, and energy portfolio, which is based off a little bit of the stocks that, or the way what I was pointed to for the gentleman's that I was the person I interviewed here, sorry. But for the gentleman's picks, I thought those were actually really, really good. And some of them were really, really good. And some I just did not like at all. I'm still researching that, still going a little bit deeper into that. If you do want updates, just let me know. I can put that in the comment section or give you the links. But one thing that's cool about M1 Finance is that when you make a portfolio and you share it, it shares it it's like a snapshot of that portfolio in that time. So if I change my percentages just one little bit, it'll generate a whole new link that I can actually share to other people, and that'll be like an updated version of the same portfolio. So that's kind of cool. And then I kind of like using that as a way of taking the old portfolio and seeing what my changes have done to my 1 year and 5 year outlook of that portfolio, or 1 year and 5 year, historical look of that portfolio. So it goes back 5 years from today, and with all the information that it has, and says, hey, listen, in this 5 year period, you would have done this. So from 2015 to 2020, you would have done this X amount, and then how much money you would have made. So then I can see also my dividend yield across that time. Again, past performance is not a indicator of future returns. I think I just said that right. So you can't always use that, but it's a decent marker, and it gives me a way of saying, okay, this is done well maybe in a recession, or this is done well in these couple years when these things happen. So it's things that I can actually look at to say, okay, how is this doing right now? Do I want to add it into my portfolio? Nothing's ever the same, but you do see similarities in a sense. So it's like, okay, I can use this, but how can I use it? Maybe my percentages are going to be different. Hindsight is 20/20, and I ain't got those glasses. So at this point, I'm really kind of just trying to pin the tail on the donkey in a lot of these trades. Even with fundamental technical analysis, looking at other old records of old charts, looking at other indicators that can actually help me make an informed choice about a long-term pick, if you will. With all that being said, it's a bit of a long intro. I'll get to let's get to the video. That's quite a bit of time, so listen at your leisure whenever you can. It's very entertaining to me, and also very enlightening. It taught me so much. But as always, hey, thanks for listening. Appreciate you so much. Here's the interview.
So, I'm going to let you look at this.
Thank you.
Here.
Oh, I got one over here.
You do? Okay. So I'm going to let you take a look at this. See what you think. Just peruse it, and I will be back in 1 minute.
Okay.
Just peruse
Nice. Okay. IWN Russell 2000, 15%, 15%, cash reserve, miscellaneous stocks. So essentially, what we got here is symbol, and it's mostly ETF invested categories. Okay. So SPY, QQQ, IWM, SPDW, SPEM, total percent ETFs, miscellaneous stocks 17%, and 15% cash reserve. Okay. Huh. Possible investing template. Okay, this is pretty cool. I'm gonna go over what I got now. I wonder if I don't think M1 Finance has QQQ. Nope, it does. There's multiple QQQs. Watch. Dang, it's 234.
I can certainly make a copy of that for you. If you want.
I'm looking it up now.
Okay.
But yeah, that'd be great. I can take a picture of it too.
Huh?
I can take a picture of it too. Technology and all that.
Either. I need to make a copy, you take a picture, but that would be kind of the basic, pretty basic template. I discussed with a couple of investment advisors. I mean, that's kind of the thing that they give you, and the main thing it does is it gives you the diversity you need.
Right.
And if you noticed, like, well, the S&P 500, you certainly know what that is, and NASDAQ 100.
Right.
So those two are going to be like 40% of your portfolio, because these are giving you great diversification, in a specific industry. I mean, I don't think you would want to have owned a lot of the wind stock with the coronavirus, or a lot of airlines, etc.
Yeah, exactly. Yeah, like even Boeing, even though it has its dividend and it hasn't said anything about cutting it yet, they're borrowing to possibly pay for that dividend.
Correct. So, I mean, when you do this type of thing, it gives you a tremendous amount of diversification, which is really the name of the game, because there can always be a Boeing, there can always be a coronavirus, etc.
Right.
So if you take a look at this, it's 68% of basically in ETFs,
Right.
which would be the way that you would be able to get certainly your biggest diversification in going in an ETF. I mean, this one has 100 stocks, this one has 2,000 stocks. I mean, so a lot of people, they say, well, if it really doesn't move fast enough, I don't want a stock to move twice as fast. Well, then you're into, you're speculating or you're heavy duty growth.
Yeah, well, so for me, right now, my I haven't invested in this yet, but my Roth that I'm like putting together is probably, it's a 90-10 split, so 90 in stocks, 90 mostly in ETFs and actually picked stocks, and then 10% in bonds. So like domestic bonds 5%, and then another 5% in international bonds, and that's through Vanguard's bond ETFs. So for instance, you got Noble, which is the S&P 500 top S&P 500 top dividend stocks, and that's 20%. VYM, that's a high dividend yield ETF.
And what is it? VYN?
Yeah, VYM. So that's the Vanguard high dividend yield.
Yeah, what does that pay you?
That one, I got expense ratio of 0.06, dividend yield 3.14%.
Okay.
I can go into more details if you want on this one.
Well, I mean, if you want to, you want a couple high dividend stocks, I mean, you can have. Well, this is a fund. It's basically an ETF or a fund.
Right.
And that's fine. And I can show you some stocks that are going to yield 6, 7, and 8%. But I mean,
Right.
they're a little more speculative.
Right, and
It doesn't have the diversification.
Right, and but I want both. So
Okay, so I would give you a couple of those.
okay, nice watch by the way. I like that. I like the face on it.
Thank you.
It's a cut. So in my growth section, right? This only makes up a smaller portion. It only makes up 15%. But this is what my growth portion consists of.
This is 7% of your total dollars, or growth is 15%. You have in here.
So yeah,
so
like,
this is 7% of 15%.
Exactly. So it's very
So
small.
this is certainly done great. This is done come see come sa. I'm not familiar with this one.
Yeah, Ubiquity. It's one that I've used personally, and I think they're a bit of an up and coming. So that's a bit of a heavy fundamental pick.
Okay, these are all great. Actually, my buddy who handles dollars for me on the West Coast has almost all of these stocks. Broadcom, that would be the only one I question. I'm not that familiar with it. Costco, Home Depot, Intel, Lockheed Martin. I mean, all great stocks.
And I had Boeing in there, but I've taken them out after. I don't care what their dividend is, but I've taken them out essentially because of the fact that they're borrowing just to make it through this tough time. And then with the coronavirus on, I speculate that it's going to be on the downtrend.
I mean, the only one I don't really know Square that well.
They own. You've heard of Cash App on the phone where you can send money. No, Cash App.
Cash App, no.
Venmo.
No.
So essentially, if I go on my phone, that's how I receive rents for my salon. So I've done last year I've done 78 grand through Cash App alone. People just sending me all the rent and everything like
Cash
that.
App.
Yeah, Cash App.
So it's like PayPal.
Exactly, but it's an app as opposed to, or just like PayPal, but it's an app where I can send money to and from people, almost like a peer-to-peer, in a peer-to-peer sense.
You could wire money to them or something.
Yeah, like via my phone, and then I can transfer all that to, like right now I have $550 in my Cash App. I send that to my bank account, it settles, it's in there, and then I can go ahead and use it on regular markets.
Well, that sounds like certainly, certainly a stock that is reasonable. I mean, it's not an Intel or a Microsoft, but it certainly is on a new avenue that's very, very popular, and the stock's acting great. I mean, it's
fintech.
$80, so.
It's what that sector is dubbed as fintech.
Yeah, I mean that's just fine. Yeah, I mean this is that would certainly be fine. So you've done a very nice job of choosing stocks. These are all stocks that are certainly growing.
Yeah, I can't say that I can take full credit for it. Like some things like Intel I added in there.
Yeah.
But I got like kind of the foundation from someone else's, and then I built on top of it, changed the percentages, and then went from there.
Fine. I mean, certainly seems to me like you've done a great job.
Okay.
And so this is 15% of your portfolio.
Right.
These stocks.
Yeah, so this is kind of like the riskier portion of the Roth IRA.
So I mean, I have miscellaneous stocks at 17%. I mean,
Yeah. Okay. So yeah. Great minds think alike.
And cash. I don't know how much your cash reserve is, but if the market has a little dip, you always want to be in cash, and I have a little cash to go in, and then these it sounds like you're in quite a few of these. I mean, if you wanted to be in a specific industry, then they have ETFs in an industry, but then you're not getting the
full diversification.
Yeah, I mean you're not getting diversification. You'd be getting. I mean, what if you had a lot in the airline industry right now? You wouldn't be doing real great. Yeah, you might have sector diversification, but it's not full diversification. Exactly. So Mike, you speak very. I mean, sector diversification. That's a pretty good term. Is it, sir? I have been watching tons of video. I didn't want to just come in here and be like, okay, sir,
dump
Good
all
for
your
you.
knowledge. Yeah,
Good for you.
I wanted to come in. Trust me, like I understand at the end of the day, it's my money, my decision, and it's like, okay, if I take your advice, it's still my decision to take your advice. So I never want to take it. Even when I talk to other people about it, I tell them, hey, listen, this should be inspiration for you to do more research.
Well, the bottom line is I'm kind of a professional,
Yeah.
and you know, and if things work out, it should have, and if not, then I'm a schmuck. I mean, that's kind of the way. Whatever. Anyway,
I've learned with the cryptocurrencies, I've learned quite a bit from that alone too. So that was an expensive lesson.
yeah, that's definitely tough to do, the cryptocurrencies.
Yeah, I'm still in it.
Okay.
So you were talking about cash reserve. So just a little bit about what I'm going through right now. My monthly income net is about like $8,100 between just W-2s. Right. So that doesn't even show the salon and even the computer consulting, which has gone down a little bit. So savings, I put about 2.5% away from all my my checks. I put 2.5% away, so that's about like $200 a month. M1 Finance, what I'm going to be doing for investing for the Roth IRA, and there's a breakdown for this. I'm probably going to be putting about $600 into that a month. Precious metals, I buy silver, so I buy like physical silver and everything. I usually buy.
How do you do that?
I usually buy it off of eBay. So,
What do you mean you buy?
so actual. Oh crap! I left it.
I happen to like the metals.
Yeah, but I buy like pure 1 ounce silver. I usually buy 5 ounce bars of silver. There's a seller on eBay. I bought from him once just to test him out. Ran the rare earth metal, a rare earth magnet across it, so I know how to test the silver, see if it's real or not, if it's just metal or if it's just steel or if it's actual silver. And I've been ordering from them consistently.
How about and you'd rather own the real product than own a silver stock?
Yes, definitely rather own the real product.
Why?
I'm a bit of a silver bug, so somewhat of a prepper, if you will. But if you own for instance, if you own the paper, you don't really own like the actual what's it called? The actual silver itself, because that's like silver futures. So I'd rather have it right now and deal with that as opposed to speculating on the market that silver will do this. Now it's a lot more liquid to own the paper though. That I understand, but I personally like and I prefer, because the way I look at silver, it's a long-term hedge, and it's something that I would possibly even give my kids or my nephew.
How about gold?
Gold, I would plan to. I'm just trying to service a lot more debt right now and pay off a lot of stuff, but I definitely want to buy into gold, maybe even buy 1 to 2 ounces a quarter or even a year, a quarter or so, or 1 to 2, 4 ounces max, maybe a year, because it's about $1,500 right now. So I do follow it, but silver is the easier one that I can get into. I'm spending probably about $100 right now.
Okay,
for 5 ounces.
Sounds like that you got a little program going, which is fine.
Okay.
I mean, I happen to, in general, today I like the metals. If you would ask me maybe 5 years ago, I probably might not have.
Okay. So do you like the metal? You like the shares, or do you like actual physical metal? You don't have to tell me that.
Shares.
Okay. Shares.
I own a stock called PAS, Pan American Silver.
And they're a miner?
Yeah, I think so. But I mean, I'd have you go to their definition on
to check it. Yeah.
But here, I mean, certainly acted well. It acts well, and there was just an article about how this person like silver.
This is
I
cool.
read this morning. What's the story? So I went
Thank you so much for this, because I did not think about adding this maybe even to my portfolio.
Adding what?
They actually have it on M1 Finance. So M1 Finance, for them to actually do fractional shares, they buy them from another company called Apex, which allows for fractional shares. So Apex will buy the entire share and then resell that to M1 Finance, so you can get a fraction of that share. but you can also, what that allows it to do is almost turn it into like somewhat of a savings account, but it's good for, what's it called? Amateur investors like myself.
Okay. So,
But pause, P-A-A-S.
so I want
P-A-A-S.
to, profile. So the profile is, PAS together with its subsidiary engages in the exploration, development, extraction, processing, refining, and reclamation of silver mines. The company owns and operates mines located in Mexico and so forth. So, I'm just reading from Yahoo.
Right.
I own a gold stock. It's had a huge move. I don't know if this is one of the premier ones. It moves a lot more than the others.
Nova Gold. Yeah, I've heard of them too. I've heard of them.
I mean, you'll see the chart and you'll say, oh my God. So, I mean, the thing about Nova Gold is it's a much more of a pure play than maybe Newport Mining or whatever. But, Nova Gold in June of 19 was $4.20. Now it's $9. I mean...
Yeah, it's doubled.
Well, it's certainly more than doubled. Now, if you looked at like a Newport Mining, they've probably done pretty well too. I mean, at 619 they were 36, 38, and right now they're 44. So you can see the huge difference between the rise in the two companies. I also kind of like a stock, Freeport Mining. Freeport McMoran. It's a lot more speculative. It's copper. I trade that one a lot. I don't know. I mean, it goes a lot with the growth, China's growth, so forth, because they use copper a lot.
Right. Yeah, and then copper is like a well-used metal, along with it has like high usages or a number of usages, along with same thing with silver.
Correct.
So it's a more of a, not such a precious metal, but it's a used precious metal.
Exactly.
More than something that you hoard like gold.
And in this article that I read this morning was really talking about silver, and the reason it liked silver, and it didn't talk about gold. But the reason it liked silver is because silver is, they use silver in industry, etc. And not only that, but people hoard it for a problem. I just put silver in there. Let's see. Okay, now, where does it say?
What's the ticker for Newport?
Freeport is SCX.
I got that one, but the one Newport Mining?
NEM.
NEM. Okay.
Yeah, that's a lot more conservative. Silver company.
Oh, that's New Mount.
Gold company. They probably have gold. They probably have silver. They probably have a mix of stuff. But I think that's mainly gold.
Newmont or Newport?
Newmont.
NEM. Oh, NEM. Okay. Cool.
I think it's NEM. I don't know.
I'm gonna put it on my watch list, and then I'll research into them later. But go ahead.
So, I think the key is for you to get yourself set up in your ETFs and your percentages.
Right.
And once you do that, and you want to play around, then this is, nothing says you couldn't move this up to 25% and bring some of these numbers down a little.
Right.
You seem to be reasonably knowledgeable about the market. And
I'm getting there. I wouldn't say all that.
Yeah, well, it's fine. That's great. So if you want to make this, let's say 25, and you want to take 3 here and 3 here for it, but these are basically the percentages that you want to work with. And so let's take a look at.
Now looking at my portfolio here, would you say this is too many holdings? Like, if I'm putting in $600 a month, do I want to cut it down?
Well, I'm not familiar with all these Vanguards. I would be in I would be in these instead of the Vanguards,
Okay.
the ETFs. I mean, what are these Vanguards? They're mutual funds?
No. So with Vanguard, one of the biggest things about them is they're a low cost. They're usually low cost ETFs. So you don't have so much of the fee drag that you would get from some of the other ETFs. So if I was to get into, yeah. So Vanguard, what is their VOO? If you look up VOO, I don't know if you want to look in your, or actually I can look in here. So VOO is their version of the S&P 500, right?
Okay.
That tracks the S&P 500.
Okay.
So you can see a yield of 1.7, but an expense ratio of 0.03. Then if we look at, I think it's SPY. SPY. And expense ratio of SPY is 0.09. And the yield is less at 1.67. So now if I look at it under assets under management, we have like 307 billion. The SPY has more assets under management than VOO, which is Vanguard's version of the S&P 500. But my expense ratio is lower, so I don't have so much in terms of fee drag, and my dividend yield is just a little bit higher. So it might be in the long run a benefit.
Yeah, Michael, that would be fine.
Yeah, that makes sense. Okay, cool. Thanks.
I mean, you've done your homework on this stuff.
Yeah.
I mean,
stayed up by candlelight,
I mean, that's fine.
Yeah.
I mean, something that tracks the S&P 500, I'm sure that, it's probably got a correlation coefficient of, I don't know, over 90.
Okay. In terms of like close to the SPY where it's like about the same and they overlap.
Yeah, I mean, I don't know if they give you a correlate, how well it correlates to SPY.
Right.
You could probably do your research and find out. But my bet is it probably correlates to SPY, 92, 93%.
Yeah, in terms of like saying, so SPY. So there's a website called ETFDB. Yeah. And you can compare the two funds, and this is what they'll show you here. I want to see if they have the correlation coefficient that you're talking about, because that's a new term for me. But you can see the comparison in expense ratio, structure, UIT versus ETF. I don't understand that. And then it tells you inception date, and then shares outstanding, ADV. I think that's like the average daily volume, right? ADV.
Yeah.
And then it gives you a little bit more. And
so, correlation coefficient is not, all it is how well it follows SPY. That's all it is. Yeah. So don't let the term confuse you. I mean, you're kind of going back. When they came out with the SPY and started trade, it was a long time ago.
Right.
And when they came out with it, I had my clearing firm.
Right.
So what we did is we went to the University of Chicago. We got a statistical teacher there, and he built us models to follow the S&P 500, and we would arbitrage the SPY against the S&P 500. I mean, it would get out of whack pretty good.
Yeah.
Because
and when you say out of whack, like the difference,
okay,
between the two,
and
then you would make the money off of that difference.
Correlation coefficient of 98%.
Okay,
and we had 5 models, and we would never put more than 2 models on. Because sometimes if IBM, had a big move, then it would skew the model. So it's how well these stocks follow, basically.
Right.
And so, like when the S&P the SPY got 8 to 10% over, we would sell the S&P and buy our model.
Okay.
Or vice versa.
Right.
And it would happen for a very short period of time, maybe 20 minutes, when news hit the tape. It's easier for people to go in and buy the SPY than buy 500 stocks.
Right, exactly.
So we had a models that were correlating 25 stocks to the S&P 500. So what we would do is, if SPY got way over, we would sell an SPY and go in and buy 25 of the stocks,
Mm-hmm.
we buy a model. Our models might have been, I don't know, $200,000, whatever. So we buy $200,000 worth of SPY.
Right.
And so that's, but you know, what you're doing is fine with Vanguard. I mean, they have stuff now that's, you know, you're going back a lot of years, Michael. I mean, you know, and it was, you know, and it didn't last long. It lasted about, I don't know, 6 months where we could do that. And then, you know, everybody got their computers and they started with the computer trading and stuff.
Right. Yeah, because what I'm seeing is like, you know, you see a lot of where they say, hey, listen, there's very few times that somebody can outperform the market. And if they do, is it luck? Is it skill? And then it's usually inconsistent. It doesn't last for a long period of times, blah, blah, blah. So the thing is, it sounds like, okay, when SPY was doing bad, you bought your model, which was actually doing better, then you sat into that for a while.
That was for a very short period of time.
Yeah,
it was
like
an arbitrage.
Yeah, it'd be like
you know
for a
what
couple
an arbitrage is? Basically,
you move from one spot to the next, and then you gain money by doing that. So like it's 98 cents over here.
Yeah, an arbitrage, a pure arbitrage would be they used to trade silver in New York and Chicago. You buy silver in Chicago, sell in New York when it gets a little out of whack, or vice versa.
Right. And you'd make the money off the difference. And you would make the money off the difference.
Yeah.
Okay. Cool.
So that's basically what an arbitrage is. I mean, then there's a risk arbitrage, which is a lot riskier. You know, you don't want to. That's when a company's taking over another company. It's worth such and such, but if it goes bad, then whatever. And you don't want to be involved in that. Anyway, so but you know, these Vanguards are fine.
Yeah. Okay.
Yeah. I mean, do you pay anything to Vanguard?
So you buy into it. Essentially, that is going to be your. I was trying to look for something. I've heard the Nova Gold and everything like that, and I wasn't even thinking. Thank you so much for putting me onto that, to buy into that. So what essentially when you buy the stock, essentially you're gonna get that taken out, that expense ratio taken out. That's gonna. You know what? I'm gonna cut it short. I don't know exactly. I would assume that you're gonna pay.
They have to be.
You have to buy the share, but then you're gonna lose something maybe on the dividend yield. So that 0.03 might come out of the dividend yield.
Better than the S&P. I mean, why would you worry about it? The SPY doesn't really.
Right.
You know, they're not taking any expenses out.
Right. And the thing is, even with the SPY, it has its fee drag, if you will, or its expense ratio at 0.09. So this has a lower expense ratio, but tracks the same stuff in the SPY. So
why not?
Yeah, and then essentially what they're doing is they have their own. Let's look at this. So if you look at them, they're pretty much like the same. I guess this would be the correlation coefficient, or this is where they correlate in terms of what stocks they have.
So the correlation coefficient would be how well it correlates to it. So if this one got out of whack a little with the SPY, you'd buy this one and you'd sell. Let's say this one got cheaper than your model. The problem is that you have to make a model of 25 stocks that follow it 98% correlation coefficient. That's tough. You have to do a lot of research and a lot of stuff
to get it right.
So, but you know,
it's pretty much spot on. So I got this graph here.
Yeah.
And I can change. Let me change the color using our friend Yahoo Finance here. If you look at it, blue is SPY.
Yeah.
And then red is VOO.
Yeah, it's perfect.
And then VOO in some spots are actually doing better than SPY by just a tad.
Yeah, it's fine.
So but then you're also, so then it follows it pretty much lockstep, but then it's lower expense ratio.
That's right.
And higher dividend. So that's crazy. That's cool.
Yeah.
All right, cool. Like I'm amazed at just like I'm getting it a little bit. It's kind of.
You've done a tremendous amount of work and research. I mean, you are certainly no novice on this. You're kind of like Warren Buffett, and you're sitting there with, I go and feed the cows, and you're surprising me. Okay.
Yeah. Well, I appreciate it. Yeah. No, but the thing is, it's confirmation, or affirmation, I should say. in some cases too. So, but then also there's certain things where you're saying, Mike, that doesn't make sense. Not saying it like that, but you're showing me, you're challenging some of the beliefs that I have, and then, but you're making it stronger in a sense.
Okay.
Yeah. So I appreciate it. But you're looking at, say, if we look at the holdings, they're pretty much spot on, and if we look at the graph, they're pretty much spot on. So that's kind of cool. But I do like, excuse me, this. Now
Do they have all those others? I'm sure they do.
yeah, so I looked up QQQ. They do have that.
Yeah, I'm sure.
IWM. I've added that.
They have this.
Yeah, SPW.
It's very small. It's the international markets. The international markets are cheaper than ours.
I've noticed that. One is so VYM is a high dividend yield ETF, but then they have VYMI, and that'll be the international markets. That makes up a smaller portion of my portfolio, but you're looking at $62.50 for that ETF, and that dividend yield expense ratio is higher at 0.3, but the dividend yield on that is like 4.29, and then if I was to compare, so that's
Then you have emerging. I mean, emerging is a little speculative. International is a little more speculative, but a lot of people feel that the international markets are really cheap compared to ours. I have some money in the international markets in a mutual fund.
now. How do you feel about that? How's it done for you?
You
over
know, I
time?
mean, it's okay. It hasn't done great over the last year or two, but you want to know something? It gives me diversification.
Right.
I mean, I've had it for a long time. I mean, I have enough dollars where, I want the diversification of, of being in international markets. If, let's say all of a sudden they get hot and they do well. I mean, why not diversify if it's there to do?
Right.
And the emerging markets are more like an apple starting out. I mean,
Startups, if you will, unicorns.
So
or whatever.
I mean, I have a, but I mean, look at the percentages. I mean, 5 and 8.
Yeah.
So they're a lot less, but I think it's just good. Diversification's the name of the game.
Yeah. I like it. What made me smile there is just kind of like, okay, my percentages. I'll just go out and say it's like I feel like I'm right. Like my percentages are right because
Percentages are pretty close.
I'm getting it from somebody that has experience. So like it's like I feel
That's right.
yeah, that's cool.
Yeah.
That's cool. That's really cool. But then so I look at this and you have these holdings here. It's diversified, high domestic, and then you still have diversification in the outside of the U.S. I guess they would say ex-U.S. I guess right? I think external. Now, how do you feel about? We mentioned aged earlier, and you were saying like, okay, hey, listen, you're 34. How long is this portfolio? Like, what's the outlook? I always look for 5 years anytime I'm looking at a chart. I'm looking at a 5-year chart more than a year.
Mm-hmm.
That makes sense?
It should be. Most people aren't though. They want to look at a one-day chart. What's it doing tomorrow? I mean, it makes it very difficult.
Right.
I mean, you could certainly look at yearly charts, not a problem. But if you think about it on a 5-year program, it'll be great.
Yeah, the shortest.
It's proven every time, and with all the problems and with all the coronavirus and Trump and the yada da da. The bottom line is, the United States is the best country to live in. It's got the best markets, and the markets have grown exponentially over the years, period. And you know what? That's just the name of the game.
The way it is, right. That's cool, okay. So then, so my thought is, I have probably about a 90-10 in terms, and just mostly ETFs, and I have a small portion for growth, right? I guess what else could I even?
I think you're doing fine. And if you want to make a copy of that.
Yeah, please. Actually, no, I'll take a picture.
And I can give you a. I can give you a few stocks that I kind of trade if you want. I mean, if
You don't have to if you don't
no,
feel comfortable, but I'll
fine
take
with
it and I'll research
I'm
it.
I'm just throwing these stocks out.
Yeah.
That's all. So
Cool,
I
yeah,
would
I'll take
say
it.
that ET is a stock that I trade a lot, and I'd probably put ET and FCX in similar positions.
And ET's pretty cheap at $12 a share.
Yeah.
12.72. How long has it done its 5 years?
Well, it's what they call an MLP. The MLPs are pretty cheap, and the dividend is fantastic.
Oof, 9.5. Jeez, that's like almost 9.6.
Yeah.
That's crazy.
So that's one that I trade. It's an oil stock. It's got a lot of pipeline, and it's reasonably volatile.
Yeah.
I mean, it moves around a little. I mean, it goes from like 10 to
It's a bit of a nasty.
13.
It's a
That's
nasty
about
graph.
30%.
But it's a nasty graph, but like at the same time, we're looking at the dividends. Even
Yeah,
that's pretty sick.
you get a huge dividend.
Right.
Another stock, which I really don't trade, this one a lot more conservative, is EPD.
EPD. Enterprise Products Partners. Okay.
I think the dividend is certainly a lot more secure, and it pays a great dividend also. If you look at EPD's dividend, you're going to be very happy.
Yeah, 6.78.
Yeah. I own a lot of that. That's one of my larger holdings. Basically for the dividend. And they have good management. ET's, their management is...
Yeah.
they're fine, but they're much more aggressive than EPD.
Okay.
It's just different. They're pushing the envelope a little more than EPD.
Now, when you say that though, and I understand it's a risk, but when you say that, do you say pushing the envelope in maybe a good way?
I think so.
Okay, so
That's
they're trying
my
to.
opinion. I mean, I own it.
Yeah.
I like it.
Yeah, there's skin in the game for that, but it's
Right.
like, because like I don't mind, because it's like, all right, cool. If anything, I would add this as like a risky portion of the portfolio.
ET you would definitely add as a risky, and EPD would be much more conservative.
Right.
ET has earnings coming out. I think 2/19. You could certainly see some action that day. Usually, when they come out with earnings, the stock doesn't do well. But you know what? Who knows?
Yeah.
But they're coming out with earnings on 2/19. FYI.
So what bucket is this though? This is your risk
That
bucket.
would be in my risk bucket. The stuff that I trade, I want. It's called Gamma, which is volatility. You don't like the VIX?
Yeah, like
VIX
VIX and T-VIX.
Okay. So,
I've seen a little bit of T-VIX. A friend was telling
okay.
me.
So the VIX has a lot of volatility. The stuff I trade, I want to have. I want them to have volatility.
Right.
I want to have something to do. So like ET, I mean, I can trade. If it goes 30% in a month, that's nice volatility. EPD goes, I don't know, 10% all year. But so
that's like moderate risk, if you will.
I would
like
say,
that,
yeah. BSX is a company that I kind of like, Boston Scientific.
Oh, okay, I've heard of that.
I like the space. They're a good company. They manage well. Moves around a little. I trade that one a lot.
What's it called? You said space, like SPCE? Or you just like that space, BS?
That space meaning they make a lot of medical supplies, but that they're using when they're operating on you, stuff like that.
And their chart over 5 years has been beautiful.
Yeah, and they're a good company. I think that if you took a look at the definition of the company, they do a lot with stuff of the heart.
Because from 5 years ago they were 1631. Now they're up to 4257 or so.
Yeah, and it's up kind of up near the high. But I still kind of like them. I mean, I will trade these very short term.
Mm-hmm.
You know, I'll buy a lot of options against them, stuff. So if you look at basically profile, so what they do is they develop, manufacture devices for use in various interventional market specialties, worldwide operations, for segments and so forth. A lot of hard stuff, cardiovascular,
yeah.
coronary, and so forth. Catheters, stuff like that. So so I would say BCX, ET, EPD. EPD I kind of buy and hold, but BCX. C&Q, it's got a nice dividend. I trade that one a little. Canada Natural Gas.
So you like a lot of energy stocks, it seems,
because they have a little action.
Okay.
I mean, that's why.
Okay.
Just kind of looking through here. Freeport Mining, FCX.
Right, I got that one.
I mean, I would say ET and FCX are definitely my biggest trading stuff.
Mm-hmm.
Corning Glass, I like a little.
I know. What's the ticker for that?
Gorilla Glass and so forth. GLW.
GLW. Now, one thing about Corning on the fundamental side, they make a lot of the fiber optic cables and things like that. So a lot of the stuff that our internet and our backbone runs on, no matter what, I see them as a company, just, and it's maybe pontificating on it, but I see them as a possible company that is always going to be doing something simply because we're expanding our fiber connectivity across the world.
Correct.
You got Africa getting connected with 10 gig and 100 gig fiber. Right. And Facebook is laying that stuff.
They're a pretty good company. Starwood, I'm very, very fond of this stock. EPD and Starwood are my two biggest stocks in my portfolio, both very, very high yielding stocks. Starwood is what they call a REIT, real estate investment trust.
Oh, okay.
And it has very, very little in malls.
They have very little in malls?
A little in malls.
Oh, so they really
small.
do.
So they're a lot more conservative than a lot of them.
Your mouse is over here now.
Starwood, it has a price earnings ratio of 12. It has a dividend 7.4%. So, so I would say the two biggest stocks I own for income, and I really don't trade, are EPD and Starwood.
Oh, okay. So those are your
they're in my big conservative income bucket.
Yeah,
they've got a lot of.
They're paying some of the bills type stuff, or
they've got a lot of cushion if the market goes down.
Now, how do you feel about taking those dividends and reinvesting them?
I do.
Okay, and that's what you
I
usually
always
do.
reinvest my dividends.
Always, okay, cool.
So here's Starwood. I mean, it's not nothing exciting, but you're getting a 7% dividend. So the chart isn't showing you that.
Right.
You hold this stock for 13.
Yeah, you're getting like 48 cents.
14. You hold this stock for 14 years, it doubles on the dividend.
Yeah, I mean, you're getting 48 cents per share in dividends per quarter.
Yeah, I mean, so that kind of would be my thinking.
Right. Okay, I'll put them on my watch list.
So that's really You know, I mean, if you see the stocks on my screen,
Right.
you really have almost all of them. I mean, you know, I watch Tesla because I want to see what's going on in the market, and I watch these, you know, because I kind of want to see what's going on in the market. You know, I own a little Schlumberger, I own a little Oxy.
You got JP Morgan on
JP Morgan.
So there's another, so that's my Roth IRA, and I won't go into this great deal because some of this stuff overlaps.
Mm-hmm.
But this is another one where somebody built this, and I just did I changed around the percentage, added a couple of things.
Mm-hmm.
How do you feel about like the financials? So, you know, they got JPM, they got Maine, Bank of America, Aflac, RBC, or Royal Bank of Canada, T. Rowe Price, TD Ameritrade, Wells Fargo. And it's like, you know, they have all these banks which may not do well in this next recession. How do you feel about actually investing in finances?
I mean, probably the most conservative one is JP Morgan. Mm-hmm. And I like JP Morgan a little. Bank of America is very cheap. Mm-hmm. You know, I don't know why. Maybe there's a reason I own a little of that. Okay. I think that the Schwab Ameritrade deal, Schwab bought Ameritrade here about 2-3 months ago. Oh, okay. I think you might want to take a look at Schwab. Interesting, maybe an interesting stock in the financials.
What is Schwab?
SCH.
SCH.
Is it SCH or SCHW?
There's SCH. Oh, SCH.
W. The reason it's kind of interesting with them.
Yeah, so this is like the actual Schwab, the company, because they have have quite a few different Schwabs in terms of stocks. They have a U.S. REIT, so they kind of do the same thing as Vanguard. They actually have all these different products, I guess, too.
Well, Schwab is one of the biggest discount brokers. I do all my trading with Schwab. They're
I remember,
a huge discount broker.
Yeah.
Schwab is cute. The biggies would be Schwab, Fidelity. You know, now that Schwab bought Ameritrade, you know, they're right up there. Fidelity is not public. Fidelity, when you have money in there, and let's say you have $1 million in an account,
right?
And you know you're trading and so forth, and they automatically sweep your cash account. You know what that means at the end of the day?
No, not at all.
They take all the cash
mm-hmm.
and they sweep it into a money market,
okay,
which is yielding, and so you get the benefit of that. You get 1.25%, 1.5% today,
mm-hmm.
etc. Schwab
mm-hmm.
does not sweep. They have them to do.
Mm-hmm.
You have to go in and manually do it.
So now that is good for maybe tax purposes?
Not tax purposes. Your money's working for you.
Right, okay.
Let's say let's say you have a $200,000 credit.
Mm-hmm.
And you know, you're waiting, you know, you're buying, you're selling, and you know, you certainly don't want on margin, that would be 7-8%. So you just kind of, you know, you kind of forget about it.
Yeah.
And then when you want to buy something, you want to do, well, with Schwab, they get to use that money, they give you like 0.02%.
Yeah.
Fidelity and the others sweep.
Mm-hmm.
Schwab, you can also go in and get that percentage, same percentage as the sweep, but you have to do it manually. Well, you know, that's a pain in the ass. So the hell's going to look manually every day at their accounts?
Right.
So, in actuality, I made a deal with Schwab before they went to no commissions. They went to no commissions recently, all these companies.
Right.
As you're probably aware. Fidelity, Schwab, Ameritrade.
Same thing with M1 Finance.
Right.
They stopped charging.
What's the name of it?
M1 Finance.
M1, okay.
They're a bit of what they call the new class of investing programs called like robo-investors. So it's algorithm or code that helps you with investing. So it offsets the human aspect of it.
They're involved in algorithms.
All right. Yeah.
Okay. So when I went with Schwab like about 1.5 years ago,
mm-hmm.
I made a deal with them. I put a certain amount of money in the account. If I had a certain amount of money in the account
mm-hmm.
and left it there, then they would give me free commissions, which was great.
Right.
Now I get back to them when they just came out with the commissions, and they're giving everybody free commissions. I called my rep. I says, they're giving everybody free commissions now. They're not doing anything for me.
Right.
And I was always pissed off that they didn't sweep my trading account, because my trading account is very complicated, and
Right.
I can have a lot of money in there, or I can have very little in there,
Right.
depending on I'm in and out of stuff every few seconds.
Right.
So they've agreed to sweep, so they sweep for me now. They don't do it for others.
So now
That's a big deal.
I want to understand what they sweep. So they sweep your earnings for the day?
They sweep your cash balance.
Okay, so whatever you have in that account for trading, what have you, they sweep it into a money market or a mutual
Overnight.
overnight. Now, what's the benefit for something that, because you're going to need it the next day, right?
Well, if I need it, maybe.
Oh. Oh.
You know.
Because you might not buy anything or trade anything the next
Correct.
day. I see. Okay. So then you have it in there and it automatically goes in there, makes you money, and then when you need to, you pull it back out, and then you have that extra, in a
But
sense,
I don't pull it.
interest.
It's all automatic. That's what a sweep is. Sweep is automatic.
No, but pull it when you want to buy something.
I'm not pulling it. I'm just utilizing it.
Okay.
And I'm short a lot of stock against options, and it changes. It changes a lot, Mike. It's a big deal for me.
No, I want it, like, this is a new term for me, so yeah.
Okay.
That's it. I'm trying to probe and understand
it's a pretty common term in a bank. A bank will oftentimes have a sweep account, and they'll put it in a money market. It's not automatic usually, and they make a shitload of money that way. In other words,
because they can take that and loan it out and do fractional.
for basically they're paying .002 for that money.
Yeah, and it's cheap money for them.
Exactly.
Right, now it's
And
from
that's how
you
banks make
generate
money.
it. Right. Because then now they can loan it out for maybe 1, 2, 10, 15%.
Well, not 10 or 15, but 3 or 4. Yeah.
3 or
no
4?
problem.
Oh, sorry.
And that's how they make a lot
I'm
of
thinking
money.
about credit cards,
That's
interest rates.
Yeah, exactly.
Right.
And that's where, and that's why they can build all these big buildings.
Yeah.
So, yeah.
And that's the kind of thing that I'm seeing now, where it's like, okay, you're moving away from these big buildings, or you're moving away from these investment companies that have these big buildings, and all they have is space in a data center, in Amazon cloud. So it's a lot cheaper, and they run a little bit more agile, if you will.
Well, they're all getting very, very computerized. I mean,
Right. True.
It's a whole different. And one of the advantages for me when I go and trade options, if I want to buy a lot of options, I'm not trading with a person. I'm trading with a computer, an algorithm.
Okay.
And that algorithm, it's got a lot of information in there. It knows when the earnings are going to come out, yada da. But it doesn't feel like I do. If I think a stock's going to move quickly, it's got a lot of gamma in it, so to speak, and it's going to have a big move. That I'll go in and I'll buy, maybe 100 options. Well, the computer doesn't have an opinion.
Yeah.
And that program does fine for that.
And then, so you're saying that that's the benefit that you have over the computer, or the computer
I
is
have a
also
little
an
benefit
assistant?
over the computer because before, that's what I did for a living. Before, you had to go into the pit, and maybe you could buy, 20 or 30 of those options before the price change.
Right.
You could probably do 150 of them now on a computer.
Yeah, before anything. Instead of like having to go out there and start yelling at your top of your lungs to buy options and sell certain things.
Yeah, and you just put an order in for, and they've got very tight markets.
Right.
And, they're not all liquid, but a lot of them are, the VIX and they're like water they trade.
Yeah, they flow all over the place, you're saying.
Yeah, they trade like water, they're very liquid.
Yeah, I see.
Huge.
Yeah, because somebody was putting me onto, and if you gotta kick me out, let me know, because you gave me more than enough to chew on. I'm gonna be looking up all types of stuff. But somebody was telling me about the T-Vix, and he was looking at it, and a gentleman that I respect, and he's taught me quite a bit about technical analysis. But he was looking at the T-Vix, and I was like, well, didn't they have an issue with the T-Vix the other day, or a VIX account, and how it was about an ETF. I think it was an ETF that buys the short of I think it was following the S&P 500 and buying all the shorts on it, and then it has issues because of the volatility was too high, so they closed it down. There's something like that.
The other day they closed it down?
Not the other day. It was just like a while. This is sometimes in last year.
They could stop trading very temporarily.
Right.
I don't really think you have to worry about that much.
Okay.
I mean, a lot of people have a lot of conversation about the VIXs and the options, and you know what? The bottom line, this stuff trades like fucking water. It's not a problem.
Right. Yeah, the reason I bring that up, and I always remember that, is like, okay, I've never heard of anything like that, where certain things go to zero, or they say, hey, listen, this is too crazy, we're calling everything in, and you got to pay up, or what have you, things like that. So, what to watch out for.
I don't know. You're hearing a fragment of the story. Sure. I mean, maybe... I mean, I've seen the VIX have huge moves, like in 2008, where it had a huge move, but, they didn't stop trading and they didn't call them in.
Right,
no.
Right. Again, yeah, I'm fuzzy on that, so
yeah.
Moving on. So,
and you're not going to get involved in that stuff anyway.
I don't think so either. Not at the moment, and even if I do, it'll probably be small. Like, if I do it, it's going to be like one of those, like, all right, cool, let's see how this works.
Maybe you buy one contract or something,
Right.
I mean, you don't want to be involved.
You're crazy.
All right, let me make you a copy of this.
Yeah, thank you.
And then...
No, this is...
Yeah, go ahead.
I was saying, this is really cool. Like, I really do appreciate this, because this is a lot of information, like...
And if you, I'm always willing to
Just close this up.
to help you. It's not a problem.
Yeah.
Always willing to give you some ideas.
No, I appreciate it, because it's like, it's one of those things where, you have one or two people that can tell you some stuff, and then it's good to, like, pull on them where necessary.
Yeah.
So I appreciate it. And I'm going to, like, look up some of these stocks right now.
Okay, so, well, I'm happy to give you these ideas and something. You take care of me when I need it, and I take care of you.
Yeah,
That's
man.
easy.
Yeah.
So, if I have a problem and I need someone virtually in the evening or on a Saturday or Sunday, you would be available.
I am the guy.
Perfect. Okay, and then I also want to talk to you and your partner about.
Yeah.
It seemed to me he had some very good connections.
Yeah.
In the schools.
Yeah.
You guys should be able to make money on what he has.
Yeah, I think it's one of those things where the only reason a lot of this stuff has happened is I'm also moving in another direction personally.
Yeah.
And I want to start using more of my skills that I've learned recently in terms of programming. I'm also looking to, just to let you know, probably another 2 years or so, maybe even move out of state. I mean, I'm 34, I'm going to be 35 at the end of this year, and I'm looking at like, okay...
where are you going?
Maybe Georgia, and then looking to get something with a lot of land. Like, I like this property here, it has some land, but I'm like looking for 20-something acres. In some cases, I saw one place for with 100 acres. But of course, what's out there? Is there internet connection? It's cheap for a reason, things like that. So I want something with a lot of land that I can do the next business, which was that agricultural technology stuff that I was talking about a while back.